Having to tell your children that you can't pay for their education is risk. Not putting together enough money for your own retirement is risk. Other risks can be managed. If you don't have enough money to perform a child's wedding in a particular fashion, that can be downgraded. But it is very difficult to downgrade education. It's very difficult to downgrade your retirement. So risk is not achieving your goals. Volatility is the sleepless nights that you spend while reaching there. How do you tackle sleepless nights? Very simple. Learn and understand about risk and volatility. Create a diversified portfolio, because high quality debt and high quality equity may not always go up or down in tandem. So March 2020, your equity portfolio fell 35%, but your bond portfolio, the higher quality, good quality bonds, which were not giving you great returns, even now not giving you great returns, but they fell lesser, or they fell very little. Gold perhaps did not fall at all, it went up. So these are some of the advantages of creating a more diversified portfolio and learning more and more about these things, reading more about risk and volatility and less about returns, and stop asking your investment advisor, isme kitna milega, start asking isme kitna risk hai, right? That is a far more important question. And remember, he will not be able to make the distinction between risk and volatility. You will be able to make the distinction. And like I said, the biggest risk is you not being able to provide for your own goals, which means goals have not been well articulated and not planned properly, right? Thank you. Many people have been asking me what to do in such volatile times. Markets have always been volatile and they will be volatile. You cannot wait for the tides in the sea to be over before you take a dip, right? You have to take a dip. Well, the waves will always be there. So volatility is that part of the market which you cannot remove from the market. It's like, you see a gold ornament. Is it gold? Of course it is. Can you remove the gold from the ornament? Is it an ornament? Yes. Can you remove the gold from the ornament? No, then it does not remain. So is that gold? Yes. Is it an ornament? Yes. Can you remove the gold from the ornament? No, right? So similarly, there will always be volatility in the markets. You need to understand. So these are times which are maybe slightly more special. And so first, it is easy for me to say what not to do. Don't consume too much of news. If you keep on seeing the COVID deaths, and you will get intimidated because you do not understand the context in which it is happening. You do not know how many people are dying due to comorbidity. You do not know how many of those people were very unfit and had diabetes and high blood pressure and things like that. So for them, maybe the death has just been preponed by 5 years. Right, so all these things are happening, so you will get scared. So stop consuming too much of data, news, nonsense which is being thrown at you by the media. That is step number 1. Step number 2, realize that volatility is not what is going to kill you. Risk is what is going to kill you. You may not be able to achieve your goals. You don't want that to happen, right? So whenever you get some news that this is going to happen, just sit down calmly, relax. Look at, let me just give you an example. Look at a company like Mahindra Holiday Resorts. It's not a great company. It's been a horrible company for shareholders. This share used to be quoting at 240, 250. Then the second lockdown came and now the share is quoting at 195. Very clearly the fall from 250 to 195 in this case seems to be the fact that there has been a COVID a lockdown, not bad results or anything like that. Company has never done well. That's a completely different matter, not part of this video. All right. Nor am I recommending this share. That is also not what I'm trying to do. I'm just trying to tell you that because of this, prices fall. So 2 things to do is, 1, to sit calm, read something, do some meditation, and make sure that you don't react in panic. You don't need to panic at all. Just sit tight, right? Fear is going to be there, but panic is still optional. Don't panic, don't do anything. So if possible, add more money. If you can't add more money, sit tight. Don't again think that the recovery will happen in 3 months or 6 months. It will not happen. It may take 3 years, right? Be ready for it. 2008 and 2019, we got a very bad lesson saying the markets will always recover in a V shape. It may not recover next time, right? The market can go down even further. We have seen 52,000, we may see 42,000 also, right? So just sit steady, don't do anything. This is the best advice. Of course, if you want the money within the next, say, 3 months, 6 months, 1 year, 5 years, 3 years, then removing some money also might make sense. Maybe you remove money in an SGP form, or rather, sorry, SWP form from your equity fund instead of removing a lump sum. That is also not a bad idea. So start doing that. So what you should not do is don't react in panic, and withdraw money. Don't do these two. Just let the money lie there. Then I will tell you what are the things which you can do. Now, what are the things which you can do? Obviously, you can add more money to whatever you are doing, provided you are at that stage of your life when you can add money. So if you're 30, 40, 50, you can add money. But if you're 57 and you're 60 is your retirement age, it may not be a great time to be adding money to your portfolio, even though you've got next another 40 years to go. So you will have to have some equity. So if you are 5% in equity, it makes no sense. So come up to at least 25% in equity, and the balance can be in debt. But asking somebody to put all the money in equity or all the money in real estate, saying, oh, this is the start of a new cycle, will not be very easy, and it will not very doable. Second, we have also seen that you need not be all or none. You don't have to be completely in equity or completely out of equity, right? So one of the things not to do would have been to say sell off everything and put it into debt. You are afraid, do a systematic withdrawal. Withdraw slowly every month. Yes, if it falls, that's still okay. But if it does not fall, at least you have some money left in equity. Or do a one-time removal of, say, 20% of your equity portfolio. But you don't have to remove 100% of your equity portfolio, right? So I'm not even saying you try market timing, but if you have money and you have a long-term view, 10, 20, 30, 40, 50 years, then obviously you should be investing more money. Don't worry too much. If you have the guts, you can do a lump sum. If you don't have the guts, you can do a systematic investment, right? What should you do if you are a retired person handling this volatility? Absolute reason for you to create the bucket theories, and you have to know how to create the buckets, right? So we are in the midst of at least a 10-12 year bull run. Forget what happened in 2020. That was more an aberration. But from 2007 or 2008-9, if you have been an investor, last 12 years you have seen a bull run. If you have done nothing during this period, you will be equity heavy for sure. And if you're retired, say you're 67 years of age or 68 years of age, it's a great time to be putting it into separate buckets. So at the end of a 10-year rally, obviously many of your investments would be doing well, and some investments may not be doing too well. Remove the ones doing well, keep them, get rid of all the junk which is not doing well, sell the ones doing well partially, and create separate buckets for your 3 years expenses, 5 years expenses, and maybe 10 years expenses. If you can create those buckets, other than that, the money can lie in your equity. So this bucket, creating the buckets, then using the 3-year bucket for your 3-year expenses, and suddenly finding the market has gone back to, say, 55,000 or something, take some more money from equity and put into these buckets. Remember, at that stage you're maybe 75, 76 years of age. So which means you have to provide for another 25 years, assuming you will provide till 100. But you also have to worry less about inflation, because you've got a smaller window to worry about inflation. So the need to be very heavy in equity keeps on going down from your age of 75. So if you think the markets are booming when you're 75 or 76, great time to get rid of big portions and converting it to an annuity or something like that, which is a assured debt return of very high quality. That is why I called it an annuity. So that is another thing you can do in a bad market like this. So the bucket theory will work. I have done many videos on this. If you go online, you will find a lot of people talking about the bucket theory. My own blog subramani.com talks a lot about the bucket theory. So learn, understand. If you can't create the bucket theory, please go to an advisor and ask him to read and then create those liquid buckets, less liquid buckets, and growth buckets. If you do all this, a big portion of your problem of what to do during volatile time goes down. And let me repeat, volatility is not the risk. Not having enough money till you die. I mean, you can't run out of your money at 97 and die at 99, right? So those 2 years, what do? So that's what you do if you're recently retired.